Ashwini Kumar Tewari, Managing Director with State Bank of India. He joins us now live to understand that where the credit growth is moving, how does he essentially feel that the impact of inflation is going to be also. Mr. Tewari, good morning. Thank you for joining us. It's your first time, at least I'm interacting with you on ET now, so very warm welcome and thank you for that. My first question to you is that I was looking at credit growth numbers, and credit growth numbers both year on year and on month have improved. Is this just a sugar rush or this is here to stay?
So good morning. Thanks for having me. Yeah, I agree with you. The credit growth is there, and it is not a temporary credit growth in my view, because this is driven by corporate growth to a substantial extent. Retail was always strong. So therefore, the corporate growth doesn't happen suddenly and doesn't go away suddenly. These are plans which have been built up over the last 2-3 years when the corporates were not drawing. They were not coming to us. Even if they had loans sanctioned, they were not drawing them. So you have heard about the large amounts of working capital limits which are not utilized or term loans not drawn. This has been coming down from Q4 of last year. And therefore, this growth, which is investment into new projects and upgradation of the projects, is a sustainable growth in my view.
Given that suddenly there seems to be a challenge in terms of growth, outlook, inflation is back. The planned capex cycle which a lot of corporates have, which is a combination of term loan and working capital loan, do you see that getting affected?
So it's too early to say that, because these capex cycles and these plans are not made suddenly. As I said, they have been making them and they've been planning for the last 2-3 years, and they are now executing them. So for them, just stopping them suddenly because of the rate hikes and all, I don't think that's going to happen. After the rate hike settles down and they've taken a look at what the interest costs are, the future capacity, etc., they may factor this in. Not for those which they are already executing, because rates can go up, rates can come down. So on the ground, we don't see any impact so far. Neither are they talking to us and saying that because the rate hike is happening, so we are going to go slow. That's not happening at the moment.
We are also looking at a new turn in interest rate cycle, which is cost of deposits will get repriced, cost of loans will get repriced. At what point in time do you think NIMs will start impacting because of this?
So the deposits repricing will happen with a lag, and the loan repricing, because a lot of our loans are linked to the external benchmarks, so they will be repriced first, and therefore initially there will be a pickup in the NIMs for us and also for the other banks in the system, and subsequently over time, as the deposit rate hikes also get priced in, the NIMs will again settle to the range which we normally have. At least for us, 3.2 to 3.4 is the typical range which we want to be in, which we have been in. So I think that will ultimately settle down, but initially there'll be a pickup in NIMs for sure.
Good morning, sir. This is Nantar also joining in on the conversation. You made it pretty clear that the credit growth, the upcycle is here to stay. It is definitely not temporary. But sir, I understand the corporate growth book. We're seeing a capex war of sorts also among the corporates. What about the retail book loan? Can you give us any guidance on that? Because now the common man is also facing pressure on the wallet thanks to inflation. Can that impact sentiment, whether it is personal loans, car loans, home loans?
Yeah, so on the retail side, so far we haven't seen an impact. Let us remember that the rate hikes are just about a month old. Started in May and then again in June. So this will take some time for it to settle in and for people to understand that what the new EMIs are going to be. And those hikes are still happening for a lot of banks as they are done by RBI. So therefore, over time, yes, the impact of these hikes on the retail EMIs may lead to some rethink on consumption or taking of loans. It hasn't happened so far. In case of MSMEs, for example, the important thing is the availability of credit, the timely availability of credit, which is they are most concerned about. They are so rate hikes and all to some extent they can only live with. So our sense on the ground is so far it hasn't impacted because it's pretty recent. Going forward, we'll have to see what that does to consumption kind of expenditure. So far, no impact on the ground.
So we're talking in the same week as the Reserve Bank of India writing a letter to Fintechs. And the conversation now seems to be that banks will come on top of Fintechs. The free run that Fintechs have had, whether it is in giving out loans, etc., is coming to an end. We're awaiting the digital lending framework guidelines that the RBI governor has promised will be out shortly. But given all of this in the background, what does it mean for SBI? What does it also mean for YONO?
Yes, so one thing is that we have been planning our own strategy, and we don't necessarily get distracted by what the fintechs are doing or not. We have been looking to engage with fintechs for collaboration purposes in many areas, including digital lending. And YONO continues to go strong because so far we have been offering the loans on YONO to our own customers. So initially it was rule-based, and subsequently it has gone on to the machine learning models, and that continues to show very, very strong growth. So therefore, directly we were not so much impacted, but our general view is that any entity which is lending in the system, which has customers at the other end, needs to be regulated in some form and shape. So therefore, what the RBI is doing, say if the fintech-based lending becomes a significant part of the system, or the growth which is shown becomes very, very strong, much more than what the system shows, clearly there is need for some regulation. So they are now moving towards that direction, and we welcome that. We don't think that necessarily the banks are going to get a disproportionate advantage either ways. It has definitely led to some spike in our SBI cards price, but market movements, we don't normally comment on them. So therefore, I don't think too much of an impact on the banks in general and for us in particular.
Mr. Tewari, a few questions that the markets would want to know. Just wanted to understand directionally, where is your ROA headed next?
Yeah, so we did achieve an ROA of 0.67 in the March 22, and our internal targets are to take this up to somewhere around 0.8, 0.85 thereabouts. Ultimately, the aim is to reach 1. And as the NPL cycle has played out, and you see our NPLs have come down sustainably over the last several quarters, and therefore our provisioning requirement has come down. Gradually, that gap between our operating profit and the net profit has to merge. And once that starts to happen significantly, the ROA will go up. In addition to that, since the rate hikes are now happening, and we hope to see a better NIMs, that will also help us in boosting our interest income and therefore overall ROA. Our target continues to be ultimately to reach 1 in the medium term, but in the short run, in the next 1 year or thereabouts, about 0.8, 0.85, that number is what we are aiming for.
You know, the other thing I also want to know is, what about your market share? And please correct me if I'm wrong here, from a 24 to 25% kind of market share. A, where is it that you're headed next? And B, what will it take for you to grow beyond this number?
So 25% market share is a lot of market share. And as of now, as you see, the last 3 years, our deposit market share has stayed around 23%. And we are comfortable with that number. We don't want it to go down too much. We don't want, of course, if it goes up, that's good. Similarly, on the loan side, it has gradually come down to slightly around 20% or sometimes slightly lower, but it has stayed around 20%. So our internal aim is also to stay around these numbers, 20%, 23% in both segments. And to take it much beyond clearly means then we have to look at the quality of that growth also. For example, in the loans, while we are focused on MSMEs today, we are focused on agri today, we are looking at newer streams of loans, but we are also cognizant that the NIMs on each of these loans, the returns we get, should also be proportionate to where we want our ROA and our profitability numbers to be. So therefore, as a bank, I think we are pretty comfortable if we stay around 20, 23 in loans and deposits respectively. In case we are able to leverage the new technology and the newer segments we are talking about, if it goes beyond that, fine. But we are comfortable with the current numbers as they stand for us.
Mr. Tewari, State Bank of India has gone on record and has said that they would be listing SBI MF soon. That soon will become very soon, or the soon will remain soon looking at the market conditions?
Yeah, so the market conditions definitely are important for us because as we have made clear a number of times that the company doesn't need capital. The company, this is a business which is not capital intensive. between us and our joint venture partner, we had decided that the listing is important for the investor community to get a good name to invest in, and also to get the kind of investors we want. And these would include some of the foreign investors as well. Now, since the FPIs are not very bullish or are taking out money at the moment, there'll be some difficulty in getting the marquee names we want. So we are not in any hurry at all. So this very soon thing, I don't think I want to comment on that, but we would wait for market conditions to stabilize. And I think, in my view, till the war is on, till the rate hikes are still happening and not settled, market conditions will remain volatile. So we are not looking at a very, very immediate thing. We are on record to say that we will do that, but we will do that when the market settles down.
The historical challenge, sir, has been managing the cost to income ratio. थोड़ा सा improvement है. When will we see big improvement?
I like that thoda sa. So, see, the cost to income, we have to understand on the cost side, we do have some rigidities. We have a workforce whose pension bill, whose salary bill, there is nothing we can do about it. And the pension bill continues to grow because of the life expectancy growing up, the yields which were coming down. Now, of course, the yields have been going up. We will see some improvement in terms of the investment which back up that pension fund. So therefore, that rigidity is something we really can't do much about. So we are focused on two things. One is the income side. That is what we are focused on. And the other thing is that we have applied to the RBI for opening an operational support subsidiary. And hopefully, as that comes into being, much of the low value work, which is today done by our own people, could be given to this subsidiary. And hopefully that in the medium term, that will help us to reduce some costs. So that's how we are looking at the cost to income ratio. The immediate focus is on the income side.
Now, I'm just going to take a leaf from your answer, which is that when interest rate cycles, they start, NIMs obviously will be higher because deposits are getting repriced with a lag. But treasury portfolios will also take a hit. So will the uptick in NIM be nullified with the treasury loss?
Yes, so treasury initially at least in this quarter will see some impact because we do have a large FS book. The overall we did have a lot of deposit growth, and therefore, since the lending opportunities were relatively less in the last 2 years, much of that has gone to the treasury. A significant part of that is in the held to maturity, where this impact is not there, but still there's a lot of books sitting in the AFS category, and that will be impacted initially. So to that extent, yes, if to the impact which the mark to market has on the AFS book, there with the NIMs, you could see some balancing out. But remember, these two come in different areas. So the net interest income directly from the advances, loans, etc., obviously is not going to be impacted. It is going to see a pickup. On the mark to markets, yes, that part will get impacted. And over time, what will happen is because our modified duration is about 2, so it is quite a short duration book which we hold. And as we go forward, as the 10 years and the various government securities, their yields go up, we will invest in the new high yielding scripts, and that over time will lead to a pickup in the interest income. So it will settle down over a period of time, but first quarter, sure, there will be an impact.
Wrap it up with one macro question. I'm going to read the comments from the MPCA, and they're talking about inflation coming down to 4% in FY24. And on the other side, Reserve Bank of India is saying that we will maintain liquidity buffer. So where is the liquidity picture headed according to you? Do you think the natural growth of credit will ensure that the excess liquidity will get absorbed automatically? Is that what you think will happen next?
So if you look at the liquidity picture, which RBI publishes from time to time, it is already coming down. The last number I tracked was, I think day before yesterday, was below 2 lakh crores, 2 trillion. So therefore, from a high of more than 5 lakh crores and even beyond, it has already come down significantly. And there are some reasons for it. One is, of course, the CRR hike, which absorbed 87,000 crores. Then, of course, the market operations which RBI does to support the rupee from time to time, they have been also absorbing some of it. So the mix of these factors has already seen the liquidity come down. And of course, the loan growth, which is happening since last quarter, is also responsible. Now, as we go forward and as the loan growth picks up strongly and more, the liquidity will further come down. And therefore, RBI is on record to say that while they will continue to support, they will control inflation, but they will also support liquidity. So we might see some action on that front also. What is the comfort number for RBI for a country our size? I'm not very sure. Maybe it's around 1.5 lakh crores or 2 lakh crores, we'll see, but we are getting there. The liquidity has been coming down in the system. So to me, it seems as loan growth goes forward, liquidity comes down further. We'll settle at some spot where RBI will be comfortable and the banks themselves will be.
Okay, sir, we're going to leave it at that. Thank you so much for joining us live today on the show and taking us through SBI's view, not just of the economy, but also of the larger plans that the banking giant has for the rest of the year.